Welcome back, everyone, to the third module in this course. If you'll remember from our first course, we laid the groundwork behind technical analysis, what it is, how it works, and why it's so helpful. In today's lesson, we're going to be deepening our understanding of the basics, so let's jump right in. First, I want to talk about how price actually moves in any market. We'll remember that this will relate back to our supply and demand module from the first course. Well, who represents supply and demand in any market? That's right, buyers and sellers. Now, the important thing to remember is that the price of any asset moves due to the imbalance between these two market participants. The larger that imbalance, whether it be large buying or selling pressure, the stronger the actual movement of price in that direction. Remember, buyers and sellers want to be rewarded for buying or selling an asset. The more aggressive they are, the larger the movement in price should be. Now let's briefly go over the table below before we move on. It should be self-explanatory by now. When demand outweighs supply, price rises. When supply outweighs demand, price falls. And lastly, when demand is equal to supply, price consolidates. Understanding consolidation is going to be essential as we move forward in today's lesson. Now, I want to talk about the different types of price movements for a minute. Price generally falls into one of two categories, continuation or reversal. So let's talk about continuation first. In an uptrend, price rises, then it consolidates, and eventually starts rising again. This is what we call bullish continuation. In a downtrend, price falls, then it consolidates, and then eventually starts falling again. This is known as bearish continuation. Now let's talk about the other type of movement, reversals. When price falls, then consolidates, and then actually reverses and rises, this is called a bullish reversal. And you'll usually find this at the bottom of a downtrend. On the other hand, when price rises, then consolidates, and then finally reverses and falls, this is called a bearish reversal, and it's often found at the top of an uptrend. What's the one constant in all these types of movements? That's right, consolidation. Consolidation zones occur in between price movements, but more importantly, these zones provide us access points into the market, opportunities for us to capitalize with trades in the direction of the trend. Now hold that thought as we begin breaking down this concept. I want to talk about the two kinds of consolidation zones you may see while observing price action. The acronyms I use help reinforce all the previous modules up to this point. Consolidation can either form a DBS zone or an SSR zone. Now, a DBS zone is basically an area of demand where buyers form support, hence DBS, demand, buyers, support. On the other hand, an SSR zone is essentially an area of supply where sellers form resistance, also known as SSR, or supply, sellers, resistance. The important takeaway here is that these zones can either be ranges or single candlesticks. As we move forward, these two labels will help us visualize that ongoing conversation between our market participants, the buyers and sellers, and understand how their interaction create levels that we now know as SR. Let's move on and talk about how we identify these two kinds of zones. Let's first reinforce the fact that both of these zones form during consolidation periods, before continuation or reversal. Now, a DBS zone will be defined using the low of the range, including wicks, all the way up to the highest opening price. Alternatively, a DBS zone can also be made up of a single significant down candle before a higher high in an uptrend. On the flip side, An SSR zone will use the high of the range, including wicks, all the way down to the lowest opening price. Alternatively, an SSR zone can be made up of a single significant up candle before a lower low in a downtrend. Now that we have our rules for identification, let's touch on the fundamentals before we move into some examples. There are three important fundamentals to consider when identifying and trading DBS or SSR zones. The first fundamental to consider is strength. Now, the more explosive the breakout from a zone, both in terms of speed and distance, the stronger the zone, obviously. The reaction needs to be obvious enough to be considered significant. In continuation, we'll want to see a higher high or lower low after observing consolidation. In a reversal, we'll want to see a break in market structure after consolidation. Remember, that's a higher high in a downtrend or a lower low in an uptrend. This will reinforce the validity of the consolidation zone. The next fundamental to consider is time. The less time spent forming a DBS or SSR zone, the stronger it is. The reason being is that a zone defined by a single candlestick means that the strength of the buying or selling was much stronger than its counterpart and showed clear pressure from the dominant market participant. A zone that forms over many sessions denotes that it took more time and participants to wrestle control from the other party. This leads us to our last fundamental, depletion factor. The strongest reaction of a DBS or SSR zone will always occur on the first test. This seems logical because the supply or demand at either zone will be strongest during that first retest or interaction. Now, the more times price comes back to retest the zone, the more the orders at that level are consumed. This eventually depletes all the orders in the zone until it gives away. So the important takeaway here is that we must be objective when it comes to defining our zones. If the fundamentals above don't stand out at first glance, it's highly unlikely that we've identified a valid consolidation zone. Now that we have a firm grasp on the fundamentals, let's look at some examples. Here we have a DBS zone, defined by the highest opening price of this down candle, and we draw it all the way down to the lowest price of this range, including this wick here. We'll notice that price made a significant higher high away from this zone and eventually comes back to retest the DBS zone. When price does come back, we see buyers step in and push price up further, making yet another high. What happens as we come back into the zone another time? Once again, buyers step in and push the price up to an even higher high, continuing the uptrend. This consolidation zone, or DBS zone, provided strong support for buyers to re-enter the market on each retest. Now let's take a look at this SSR zone and how it's defined. As you'll see here, we defined it using the lowest opening price, all the way up to the highest high, including this wick right here. This creates our SSR zone, and as we'll notice, price came back into the zone and was cleanly rejected before continuing to the downside. Now, this won't work every time and usually works best around high time frame SR levels, but you'll start to see some patterns throughout these examples that should get the gears turning in your brain. This module alone is jam-packed with helpful information that can easily be implemented into trading strategies. So let's move on and look at some single candle zones. Here we have a DBS zone consisting of a single candlestick. Remember, this is defined as a down candle before a higher high in an uptrend. Once identified, we can see what happens on the first test of this zone. Price violently bounced off the zone and continued its uptrend. Remember our fundamentals? The depletion factor here was still fresh, meaning that it was untested, and we saw quite clearly how price reacted from that first test. Now, if price comes back to retest this zone a second or third time, we can safely assume that the reaction won't be nearly as strong as that first test. Now here we have an SSR zone consisting of a single candlestick as well. Remember, this is an up candle before a lower low in a downtrend. We notice that when price comes back to retest this zone, it's sharply rejected and continues on to make a lower low. Do you see how patient sellers could have caught a nice short entry with layered asks within the SSR zone? I definitely do. In the next part of this module, we're going to dive deeper into some key strategies traders can implement using DBS and SSR zones. Thanks for watching, and I'll see you soon.